Hello and welcome to the week ahead with me, Fiona Singota, Senior Market Analyst here at City Index. And this is for the 17th of March, so the week commencing 17th of March. So just quickly, as always, I'm going to ask you to read through the risk warning. I'm just going to pop myself on mute whilst you do so. Okay, fantastic. So let's click over and just before we quite sort of have a look at what we'll be watching this week, just want to take a quick look at gold because gold has been catching our attention as it broke out yesterday, risen to fresh all-time high of just over $3,000 the ounce. Really interesting reactions that we've seen to or gold's reflection of what's going on. Obviously, we've got ongoing uncertainties regarding the US economy, given Trump's trade tariff announcements. I mean, this week we've had a slew of announcements, haven't we? We've had 25% trade tariffs coming into effect on steel and aluminium. Then we've had retaliatory tariffs from Canada and Europe. Then we've also had Trump threatening 200% trade tariffs on alcohol, so wine, champagne, alcoholic beverages coming from Europe. So there has been a lot of tit for tat measures. There have sort of raising the prospects of a trade war or trade war on multiple fronts for the US. So that's raised concerns over the outlook for the US economy. Recession fears have been quite building, and as a result, safe haven demand for gold has been significantly stronger, helping to push the precious metal above its previous all-time high of 2,956 to the above 3,000 level. Also this week we had US inflation data, which showed that both CPI and PPI came in cooler than expected. CPI eased to 2.8%. Down from 3%. It was expected to cool to 2.9%. Now, this is really interesting, I think, because the thing to bear in mind here is whilst inflation has cooled, suggesting it's on the right track, the trade tariffs that Trump is applying and implementing are expected to be inflationary. So obviously, it's too soon for those inflationary impacts to be showing through in the data, but that is expected to come. And it's those sort of like inflationary concerns which are adding to the recession worries, because if inflation is rising, business confidence, consumer confidence, investment, household spending showing signs of weakening means we could be heading for that sort of stagnation with higher inflation. So stagflation trend, which really does challenge the Federal Reserve's ability to be able to cut rates in a way to be able to support the US economy. So again, cooler than expected inflation, though it does support the view, for now at least, that the Fed would continue cutting rates at some point should inflation continue to trend lower. And that is obviously also supportive of the precious metal, helping it higher. Now, obviously, the upbeat mood in gold is not being reflected across the other areas of the market. Let's not forget, key point to be watching out for next week is the Federal Reserve interest rate decision. So, I mean, this is going to be really, really interesting. But just to finish recapping this week, we've seen further declines in equities. Meanwhile, the US dollar has managed to stabilize, but that's after it fell 3.5% last week. So some level of consolidation was more than likely this week. Same with US stocks. We've seen them continue to fall, actually. This is Monday, where we can see them breaking down that bearish engulfing candle, coming down to a low yesterday. The S&P 500 of 5,500 has just recovered above the 55.50 level and closed above there, which is quite interesting. But RSI obviously very much in overbought territory. So just moving ahead to key focus next week will be on the Federal Reserve interest rate decision, which is due on March the 19th. Now, we expect the central bank to keep interest rates unchanged at 4.25 to 4.5%, extending the pause to the rate cutting cycle, which was applied in January. So there was no move from the Fed either in January. Now, heading into the meeting, as I said, inflation has cooled. Underlying inflation also cooled to 3.1%. So, you know, as I said, inflation is moving in the right direction, at least for now. Also, we heard Federal Reserve Chair Jerome Powell speak last Friday, and he said that he considered economic growth to be steady and the labour market stable, which suggests that the Fed doesn't really have any reason to be cutting interest rates right now, and, you know, really supports the view that they're in no rush to do so. Being cautious gives them time to assess the impact of President Trump's trade and immigration policies on the economy, and particularly on inflation. So, you know, I think, as noted by Powell, the Fed is in a good position to adopt a wait and see approach for greater clarity to this week's, you know, for greater clarity on the outlook for inflation. And I just think, you know, this weaker CPI and PPI that we've seen this week is not really going to challenge that outlook. We do also have US retail sales, which are due at the start of next week. Now, I think they're going to be really interesting as well. Again, they're not going to change the outlook for the Fed dramatically at all. But it's worth remembering that retail sales plunged last month. They fell really quite sharply as consumers pulled back following that busy holiday season. Now, I think the markets are going to be keen to see whether this was a one-off or whether this is actually the start of a slightly new depressed trend. So given the rising recession worries and the sort of deteriorating consumer confidence owing to Trump's trade policies, it'll be interesting to see how this may be reflected in retail sales over the coming months. You know, should there be signs that household consumption, which is a key driver of the US economy, is weakening, then that could, you know, really aggravate or add to recession worries. So that's a data point to be watching out for as well. Just technically, as far as we're looking here, I mean, we've had a very steep sell-off from the that all-time high of 61.40 to the low of 5500. We are now, as I said, back above that 5500 level. And that's just bringing this RSI out of oversold territory, sorry, which told us that the move was a little bit overstretched. So a period of consolidation or even a move higher is you know, quite likely in order to get that RSI out of oversold territory. So, you know, we could potentially see a move back towards the 5600 level, and, you know, but there's not really a significant resistance level up until around the 200 SMA there, which is at 5750, or even the 5770. We need to rise above that level to really sort of, you know, stabilize and negate this sell-off that we've seen on the S&P 500. You know, I think once we have had a period of consolidation, there is a potential for further losses if recession concerns continue to rise, and in which case then we could see a move below that 5500, opening the door potentially to 5400 down here. But if we do see that the Fed again tries to reassure over the health of the US economy, then that might be a positive as far as risk assets are concerned, and we could find that that does help to at least stabilize this sort of steep sell-off that we've had. Just going to bring up the Nasdaq as well to have a look at what's going on there. Similar, I mean, you know, we've seen that extremely steep sell-off down below the 200 SMA, and we've sort of found support here around that 19,160 level. That's where we had the recovery on Tuesday. That's more or less where we had that recovery again on Thursday. And today we're seeing a move higher, just as far as levels to be watching. Again, we're just bringing that RSI out of oversold territory, so potential for a move higher again above 19,600. That would be initial level to watch for, and then above that you've obviously got the 20,000 mark to be keeping an eye out ahead of 20,300. Rise above 20,300, that's going to sort of offer a little bit more stability to the outlook as you get above the 200 SMA, which suggests that buyers will be back in control. The other one that's just going to be having a look at as well is Euro US dollar. There isn't much in the way of Euro US dollar Euro data next week. I think a lot of attention will be on the trade war that seems to be heating up between the US and the EU. I mean, if we have a look at this as the Euro US dollar, the euro has rallied very hard at capitalizing on that weaker US dollar across the beginning of March. More recently, we've seen this more consolidation pattern as we've seen the US dollar recover from that 5-month low. That was the high of 109.40, which was the high of that we saw back in November. That was exactly where the resistance was found before the price eased lower. So, you know, in this consolidation phase, not much data as far as the euro is concerned. So it's going to be the US dollar which is driving the price movement in this pair, unless we sort of see a big trade tariff and trade war news. So I mean, again, just having a look, the RSI, and I've said this several times this week, in fact, is, you know, RSIs on several charts have been overstretched, have been in overbought or oversold territory, suggesting that the trades are very much overdone. So so periods of consolidation are actually a pullback from what we've experienced is very likely. Just on the downside, as far as support is concerned, 108 is the level to be looking out for. And then even below that, you've got the 200 SMA at 107.35. But, you know, it doesn't really negate that near-term upward trend unless we get to around the 106.20 level. But if we do find that Fed Powell, for example, next week is more cautious, then we could find, you know, concerns. If we find that sort of if Powell raises concerns out of the outlook for the economy, which is unlikely given that we only just heard from last week saying that, you know, there's reason to be concerned. So, I mean, there is potential for a down week for euro next week on that revived USD strength. But, you know, if we do see a stronger euro, it needs to break above the 109.40 level to continue rising towards 110, which is a pretty key psychological level. Now, the other one we're going to bring up is obviously GBP USD, because not only have we the Fed interest rate decision next week, but we also have the Bank of England. Now, the Bank of England, they cut rates by 25 basis points in February, and that was to 4.5%. It was a more dovish than expected vote, that vote of 7-2, where 2 members actually voted for a 50%. Sorry, a 50 basis point rate reduction to 4.25%. So basically, this month's meeting is coming as inflation did actually tick higher to 3% in January. That was up from 2.5% in December, and it's the highest rate that we've seen inflation since March last year. Core inflation also rose from 3.2% to 3.7%. Interestingly, we've seen this uptick in inflation, but GDP actually contracted 0.1% in January, which again, it points to this stagflationary trend. The Bank of England cut its growth forecast as well, let's not forget, to 0.75%, slashed in half. Now, as I said, Bank of England is expected to leave rates on hold, with the market pricing in around a 77% chance of a 5 basis point cut in June. So still a few months away yet, and potentially again in November. But I think it's less clear cut definitely than other places. Other global central banks, because there are signs of that sticky inflation, which is expected to rise to 3.7% in Q3, meaning there's sort of, as I said, significant uncertainty surrounding potential for rate cuts. But at the same time, we've obviously got this very weak growth potentially contracting in Q1, suggesting that the chances of an overheating economy are very unlikely. So anyway, but this uncertainty surrounding Bank of England rate cuts is actually lending support to the pound, which rose up in a similar way. I mean, we've seen strong gains in the pound in a similar fashion to the euro, reaching a high of just below 130 this week, highest level for 5 months. Again, a reaction to a weaker US dollar. And the pair's actually eased backwards since then. We're seeing this consolidation just tipped very slightly into overbought territory, seeing some consolidation, which is completely usual, after seeing such a strong move. So, if we do see that the Bank of England sort of point towards perhaps a more dovish approach to rate cuts, given concerns over the growth outlook, then levels to be watching on the downside, particularly if the Fed is cautious, is around the 128.65. That's the weekly low. Below that, you've got the 200 SMA there at the 128 level. If you've got a more hawkish sounding BOE and potentially a more dovish sounding Federal Reserve, again, seems unlikely from the Fed, but everything's possible. Then be watching for a rise above the 130 level. If we get above 130, then a 130.50, then that obviously then brings in 131 as the next level to watch on the upside. So we're sticking very much with, I'll tell you what, should we have a look at the FTSE? Let's have a look at the FTSE. It's been a while since we've looked at the FTSE. Because there are plenty of central banks. We've also got Bank of Japan next week as well. But let's just take a quick look at the FTSE here whilst we're at it. The FTSE has, as we know, fallen away from that all-time high of 8,910 reached at the start of the month. Pretty sharp decline, not as much as the other the US equities. Obviously, we're finding that there could be a little bit of a rotation towards Europe and other areas out of the US, which could be beneficial for the stock markets outside of the US. Seen this recovery from that low, from the low that we saw of there we go, the low of 84.60 earlier this week. Recovery heading towards 86.15. That's the level to be watching on the downside. If we get above that, I think it's a much more neutral position, and we could potentially be looking back up towards the 87 level, towards the 88.50 on the upside. Downside, watching out here for the 84.70 level. That was the previous all-time high that we saw back in May 2024, so quite a while ago. That was the 2024 high, we'll label it that. So that's the level to be watching on the downside. So just now I wanted to talk about USD Japanese yen, because we do obviously have the Bank of Japan interest rate decision as well this week. So three major, there's the SMB as well, but we're not going into that. The Bank of Japan is expected to keep its interest rates unchanged at 0.5% next week. So that's at a 17-year high. And that comes after a 25 basis point lift in January. The meeting comes after a downward revision to keep GDP. So after a downward revision to the GDP annualized, which was at 2.2% in the final 3 months of last year, that was below the initial estimate of 2.8%. And basically because there was weakening in consumption. Now, interestingly, household spending was also cooler than expected, and that could be a sign of sort of this higher inflation impacting household spending. So, but the slowdown in spending could potentially prompt a more cautious approach from the Bank of Japan. I think if we see a more gradual approach from the Bank of Japan, it also gives them more time to assess the impact of January's rate hike, as well as the potential effects from reciprocal tariffs from Trump, which are expected to come into effect on the 2nd of April. And then it also gives the Bank of Japan time to really assess the impact of big pay increases at major companies. So Japanese companies are offering workers the largest pay increase in 3 decades. Now, the Bank of Japan will want to see whether that translates into increased consumer spending, which obviously adds to additional inflationary pressures. So if we do see, I mean, we're not expecting a rate cut, but it obviously means that the attention will be in the in comments from the Bank of Japan. Any sense of hawkish comments could give the yen a lift against the US dollar. Now, obviously, we've got the Fed meeting as well on the same day. So this is on Wednesday, so it's going to be quite a volatile day for this pair. As far as the chart's telling us, you know, we can see it's trading in a downward channel, formed a series of lower lows and lower highs. It did just test the lower bounds of that channel, and it's recovered up. That was from a low of 146.50. This week, recovering up, just testing this level here, which is 148.60, which is the low from the December. Now, if we get above that, obviously you've got the 150 round number to be looking out for, and above there 151.60, which is the fib, the 38.2% fib retracement. On the downside, potential for a retest of the level here, which is the 147 level, which is the 61.8% fib level. That's from the low Monday, sorry, the low of 139.50 to the high of almost 159. But yeah, for now, there's nothing telling us that that downtrend is over. So, you know, until we see a structural change in the chart or an indicator giving us a clue that that is definitely, that's in reversal, then we would assume that the downtrend could continue. So what else? Oh gosh, sorry. So the other thing, sorry about that, my computer fell on the floor. So other things to be watching out for next week is China data. So we've got a big lot of China data coming out next week. So we have on the Monday, we have the retail sales and industrial production for China. So which will be really interesting, because if we think about when this data is coming, we've just had the end of the 2 sessions in China, which concluded on Tuesday, where Chinese authorities maintained the 5% growth target and its fiscal deficit target, and also was talking of increasing accommodative policies in order to stimulate domestic demand. We also had the People's Bank of China underscoring its commitment to supporting growth through interest rate cuts and reductions in reserve requirement ratios when needed. So that was all very encouraging, and these were positives to be taken. But there is a rather unclear picture in China as it also assesses the impact of US trade tariffs. There are also retaliatory tariffs, and these tariffs are coming to China when it's in a very different position to where it was in 2016. You know, we've got obviously domestic demand remains very weak amid the ongoing property crisis, and there's also sort of, you know, slowing. We've seen depressed manufacturing. So data obviously is going to be watched closely for clues over the health of the consumer. Chinese retail sales are expected to tick up very slightly to 3.8% from 3.7%, whilst industrial production is forecast to ease from 6.2% to 5.3%. Now, if we get weaker than expected data, that could obviously raise some concerns over the outlook of the Chinese economy. But I think it's also worth bearing in mind that we have seen a really strong performance from Chinese equities and Hong Kong as well. We've also seen a really strong rally, picking up from this 2025 low of the 18,665. You know, we've taken out a couple of really key supports, a couple of really key resistance levels above this one here, which was capping the gains in November, again in December, above 22,000. Taken out this high from October and pushed up to a high here of 24,500. Now, that was last seen, so that we have a clue where we are, last seen in February 2022. So this was sort of, you know, post the highest sort of post-COVID recovery, if you like, that we've seen for China. So really encouraging numbers here. I mean, if we do see stronger than expected figures, then we could see continued gains in the Hang Seng, looking towards 25,000 on the upside. As far as sort of support levels concerned, this one here, 23,600, is a support level to be watching, as that's the high that we saw. That's the high that we saw back in October last year. So that's the level to be watching. But yeah, this uptrend is very much still intact. We have come out of overbought territory. We are seeing a little bit of cooling in momentum, which is to be aware of. But you know, we seem to be heading higher for that one there. So I'll be watching out for a break above that level to extend those gains. The only other one to really be taking a look at is US dollar CAD. Obviously, we've got US dollar CAD. The loonie is very much caught up in the trade wars that are going on. We've got Canadian inflation data next week. That comes after the central bank cut its key lending rates by 25 basis points last week to a lowest level since 2022. So we're now at 2.75% for the interest rates in Canada, which is basically in the middle of their neutral policy rate between 2.25 and 3.2%. Now, the move comes as inflation is expected to remain below that 2% target level, and as the economy faces, you know, ongoing trade tensions with the US trade tariffs, retaliatory tariffs to the tune of over 21 billion have been applied by Canada onto US imports. So, you know, business confidence is being crushed, and the impacts won't be showing up in this inflation report. But I do think, with that in mind, we could be expecting some weaker reports down the line. The loonie has actually held up pretty well given what the Canadian economy faces. However, that is also a function of the weaker US dollar, very much trading within the sort of familiar territory that we've seen around 144.60 capped on the upside, and on the downside by that 143 level. We've seen it come off that 50 SMA a couple of times, found support there. So, you know, any sense of weakness in inflation data, then we could see some weakening of the loonie, which means that 144.60 level could be tested on the upside to open the door to 145.50. On the downside, break below the 50 SMA is going to be key first at 144.20 in order to get below the 143 level to create a deeper sell-off potentially towards this level here at 141.75. So that is all we have time for this week. It always flies, doesn't it? But thank you so much for joining with me, and I look forward to seeing you again next week.